Okay, so in this video, we're going to talk about setting your take profit, which is where you get to actually win money. I know we've talked a lot about risk and stop losses and losing trades, but now we're going to talk about winning for the first time, which is nice. So first off, a lot of people don't trade with the take profit. Some people do it because they don't plan any of their exits, like we talked about in the very beginning. But some people who are professional and actually trade really well, they'll use a stop loss, but they won't use a take profit. And what that means is they use some form of what's called a trailing stop. And what that means is essentially that your stop loss will just kind of increase as the price goes up. So if you bought here and your stop loss is here and the price goes up, the stop loss kind of moves up below it. Most exchanges will have some kind of built-in trailing stop that'll do it automatically, but I don't think that that's the way consistent traders and professional traders will do it. What they'll do is more of like a manual trading stop where, they set their stop loss there, they don't have a take profit, and then if the price kind of does like that, they might move their stop loss up to there, and then if it goes like that, they kind of move it up, right? And they're kind of just slowly adjusting their stop loss, but never taking profits anywhere. They're kind of just waiting for the stop loss to hit. So there are some pros and cons to that. A pro would be, well, obviously this could just kind of keep going up forever. Like if you would have set your take profit here, yeah, you would have made money there. But now if this ends up coming back down and hitting that stop loss, that number is bigger than that number. So, you would have made more money. And this could keep going on essentially forever, right? The downside is, if you set a take profit like there and a stop loss there, or if you would have set a take profit there, and let's say the price kind of goes up to here, and then you move your stop loss here, and then it goes up and it hits your take profit, your hypothetical take profit, then it comes down and hits your stop loss. Well, if you had just set a take profit, you would have gotten out here and made good money. But now your moving trailing stop got you out here, so you actually made less. So in this case, you're actually leaving some money on the table. I mean, if you look at just the math, technically this can go up forever. So the upside is, infinity, versus here the downside is usually somewhere between your entry and your take profit. So you could argue that this is a better way to trade than this, and not saying you should or shouldn't do it, just kind of putting it out there. I think it's good to preset your take profit and stop loss. It sort of hones your ability to predict where the market's going. I also think when you talk about, your win percentage, we were talking about it earlier, like what qualifies as a win. If you have a trade that you had a stop loss here and then, one like that, and you moved the stop loss and it got out, pretty close to above the entry, versus one where, it went up like this and you moved your stop, you moved your stop, you moved your stop, you moved your stop, and then you got out up here. Those are two very different outcomes, very different, risk rewards, but they both count as wins. So, I think trades are either wins or losses. So then it's like bundling both of those trades into a win kind of muddies the waters with the numbers a little bit. Obviously, at the end of the day, your goal is just to make money. So whatever works. But just wanted to talk about, sometimes you don't even have to use a take profit. You could trade this way. But let's talk about if you do want to use a take profit. Okay, so your stop loss is very much linked with your risk, how much you want to risk. It's very much linked with your position size, right? We kind of talked about that in the previous videos. Those things kind of all go together. Your take profit is very much connected to your risk reward. And actually, it's not really the entire risk reward, because if you have like a 1 to 2, what happens is this number is always a 1. If you're risking 10% or $10 or $100, right? That number is going to be a 1 no matter what. What creates the 2 is where do you put your take profit. If you put it at 200, you would have a 1 to 2. If you put it at 500, you would have a 1 to 5, right? That makes sense, right? So you could argue that the risk reward is telling you where to put your take profits, right? This number here tells you where to set your take profit, right? Well, as we learned in one of these previous videos, I think this one, you don't want to set your take profits and your stop loss, your exits, based on your numbers. You want to do them based on the charts, right? So you don't want your risk reward to determine your take profits. You want your take profits to determine your risk reward, right? So let's use our good old inverse head and shoulder pattern we've been using. And let's say you want to get in here, and this distance between the neckline and the head, which is what you're predicting the price is going to go up, let's just say that's 6%. And let's say the distance from the neckline to the right shoulder is 4%. So you would set your stop loss there, and your take profit, up here at 6% up, right? Again, I'm not saying that this works. I'm condoning this or anything. This is just, I think it serves as a good example. So this trade here, this trade setup, would give you a 1 to 1.5 risk reward ratio, right? Because 6 is 1.5 times 4, right? So now you've used the chart to determine what your risk reward is. But if you have a system, you probably have some kind of risk reward level in mind that is your minimum, right? So if your minimum is 1 to 2, that would mean you have to set your take profit like up here, right, at 8%. But your signal might say that that's not necessarily likely to happen. Like, you don't know what's going to happen. What you know is that it's very likely to go up to here. So what do you do in that case? In that case, you should not take the trade, right? You should sit on your hands and say, okay, I know there's an opportunity here, but the risk reward isn't good enough for me here because my risk reward is 1 to 2. You can experiment with lowering your risk reward temporarily. That's fine. And that's part of what your risk reward is there to do. It's there to determine what is a trade that works with my system and what is a trade that doesn't work with my system. So you'll come across a situation like this and you say, this trade does not work with my system, I'm out. What if the opposite happens? Let's draw another one just to keep it clean. Let's say you have that same 4% drop, but let's pretend now that neckline is, I don't know, let's say 10%. And this isn't to scale or anything, but you get the idea. So that's a 10% profit because that's what the signal says. So in this case, you have a risk reward of 1 to 2.5, right? Because 10 is 2.5 times 4. So in this case, the trade is higher than your risk reward, so you could take that trade. You would say, okay, I can get in on this one. But where would you put your take profit? Your take profit is 1 to 2, so that would mean it would be at 8, right? It would be at 8% up. But you don't have to take your take profit there. Your signal is saying that your prediction is that it'll go all the way up to here. So you could set it at 10% and get a 1 to 2.5 risk reward. The risk reward is there to tell you which trades not to get into, but it's also there to tell you what the minimum you're looking for is. It doesn't tell you what the maximum is. It doesn't say you have to take a 1 to 2 trade. You could take a 1 to 2.5. You could take a 1 to 4 trade. I mean, why not? There's no problem with making too much money. Like we talked about in earlier videos, there is a limit to how much you can risk because you could run out of money. It does have a certain effect on your account. There's no amount of money that's, this trade was too good, I made too much money on this trade. It doesn't work that way. So the risk reward shouldn't limit you. You could do it anyways if you just want to play it safe and say, it's an even safer bet now because I get 1.2 here. So even if it doesn't go all the way, you can do that too. That's what risk reward is there to do, to tell you which trades not to take and what your minimum take profit should be. So let's talk about what is a good risk reward versus a bad risk reward. We've talked about that it doesn't really matter, but you do hear a lot of people say, you should only take trades that are 1 to 3 reward to risk, or 1 to 4, or 1 to 2, or whatever. As we showed before, that doesn't matter. You could still lose with a 1 to 4. You could still make a lot of money with a 4 to 1. I actually think that a good way to start testing a system or to start trading or to kind of ease into it is to use a 1 to 1. This is sort of my opinion, but I'll give you a few reasons why I think this is the case. So the first thing is that if you start with a 1 to 1, meaning like if you get here, you set your take profit there, your stop loss there. I'm actually using the grid lines to create a scale. So, 1 square up, 1 square down, let's call it 1% up, 1% down, whatever it is. It's 1 to 1. If you start there, what you can start to do is as you trade, you can start to say, okay, I notice that after my take profit gets hit, the prices kind of tend to go up. And we'll talk about that in a later video, like adjusting your take profits and stop losses. I notice that it usually goes higher. So I have, let's say, a 60% win percentage there. And so you start raising. And you say, okay, what if I go to 1 to 2, right? And you notice, oh, it doesn't really have a big effect on your win percentage. You actually tend to win about the same amount, maybe a tiny bit less. And you can kind of keep going and then say, okay, now I got too high. Now I'm only winning like 40% or whatever. And you can kind of tweak it. Because you should try to increase your risk reward as much as possible, obviously. But I don't think you can do that the other way. I don't think you can start with where do you start? Do you start at a 1 to 10? And then say, well, I'm not winning any trades. And then kind of work it down until you get to 1 to 3? Like, where exactly do you start? I think starting at 1 to 1 makes more sense to kind of work your way up rather than try to work your way down. The second reason is the amount of opportunities that you're going to get with a 1 to 1. So if you remember on this trade, we couldn't take this trade because it wasn't a 1 to 2. And if you had a 1.4, you would get even less opportunities. Now, the good part is if you have a 1 to 1 and you're taking more trades, you're collecting more data, you're seeing what works, you're seeing how the trades play out. You can kind of use all that information to sort of tweak your settings. Versus if you have a 1 to 4, you're only getting probably 4 times less trades, and you're not collecting as much data. You're not seeing if the system works. But the opposite side of that is you might be over trading. You might be trading too much with a 1 to 1. You're not taking the best trades. If you wait for a 1 to 3, 1 to 4, or even a 1 to 2, you're only taking trades that have good upside, which means you're kind of waiting for the real juicy trades. So that might be a downside to doing 1 to 1. But again, you're trying to increase this number over time. So it's not like you're going to stay there. The next thing to keep in mind is that if you buy any chart at any moment in time and you put your take profit there and your stop loss here, right? Let's just say 1 to 1. The chances of either of those two things happen ideally is 50-50, right? If everything is random and the market can move in any direction, the chances of it going up versus going down is 50-50. Which means that the chances of it going up to here, doing a 2 to 1, is lower. The chances of it going up to here versus going there is even lower than that. Now, of course, like we saw before, if the price goes up to here less times than it goes up to here, that's fine because you're winning much more money when it goes up to here. So you can have a lopsided win percentage, right? You can win much less percentage of the time and still make money. But that is something that you should be aware of. As you increase your risk reward, you will naturally win less trades because you're trying to cover more distance here, and it's just probabilistically, mathematically less likely to happen. So you have to be aware that it is going to decrease your win percentage, which is fine because you can still make more money, even with a lower win percentage, as we've seen. But if you're doing a 1 to 1, you're going to win more often, right? Even just mathematically, you should win 50-50. That's going to do, and I've talked about it before, it's going to build confidence. And I know that sounds a little wishy-washy and emotional. Like, it's kind of like, who cares if I do 1 to 4 and I have a low win percentage, I'm still making the same amount of money, if not more than a 1 to 1. I think confidence and emotional reactions to the markets and stuff really do play a bigger role than a lot of people give it credit. So if you're winning more often because your risk reward is smaller, so you're just more likely to win more, it's going to encourage you to keep testing that system, to keep trading, to keep moving forward, versus if you're testing out a system that's 1 to 10, and you have a 12% win rate, you're going to make money, but you're losing pretty much 9 out of every 10 trades, right? And that doesn't feel good to lose 9 out of every 10 trades. You're you barely even know if this thing works, because even if you win 1 and lose 9, that's not even a big enough sample size. You probably have to do 100 trades, which means you have to lose 90 trades and win 10. It's a more difficult thing to wrap your head around. I think it makes testing a system more difficult. It's another reason why I think you should start here, get as many trades as you can, kind of build your confidence with the system, make sure it works at that level. I mean, if it doesn't work at that level, it's certainly not going to work at this level, right? And then you kind of work your way up to a higher risk reward. This is all sort of my opinion of why I think you should do it this way. Some people might say the opposite, and that's fine. But anyways, that's everything about take profits. I'll see you guys in the next video.